Welcome everyone to another episode of the Foundation series of videos covering the basics of accounting. In this episode, we are going to explore the accounting equation, which forms the basic framework in which we record business transactions and prepare the relevant financial statements. So in this episode, we are going to learn about the accounting equation and what it represents and what are the components of this equation. We are going to learn about how we can apply the accounting equation in analyzing and recording business transactions. And finally, we are also going to see how the accounting equation can be used to construct the different financial statements. The accounting equation forms the basic framework on which business transactions are analyzed and subsequently recorded. In order to understand the components of the accounting equation, we need to go back to the nature of business. A business is formed to provide products and services to its customers. In order to provide these products and services, a business will need resources. Examples of resources that will be required are cash. Cash is required to pay suppliers and workers. Now, to encourage sales, credit may have to be given to customers. Debtors are amounts owing by customers, which represents the right of the business to collect cash from its customers. Stocks or inventory are required for sale to customers or to be used in the manufacture of products that will be subsequently sold to customers. Buildings or premises are needed to conduct the business operations. Machines or equipments and vehicles are required to operate the business activities. Now, all these resources will be supplied by the suppliers of capital. These suppliers of capital will therefore have a claim on these resources. Now, there are only two possible sources of the supply of capital. The first source is from parties other than the owners of the business. These are the suppliers of goods and services or creditors, and also the lenders of capital. Now, the other source of capital will be from the owners through the capital contributed by the owners and also the profits that are generated from the business activities. These sources represent the owner's claim on the resources of the business. Now, the existing resources controlled by the business is also known as assets. The claims by the suppliers of goods and services and lenders represents present obligations of the business to external parties and must be repaid in the future. These claims are often known as liabilities. Finally, the owner's claim on the business is referred to as equity or owner's equity. Now, therefore, the total resources controlled by a business should equal to the total claims on these resources. And consequently, the total assets of the business must therefore be equal to the sum of its liabilities and equity. This forms what we call the accounting equation. Now, the accounting equation can be rearranged to present equity as a residual interest on the resources or assets of the business after settling or repaying its external obligations or liabilities. This residual interest is also known as the net worth of the business. Let's now examine equity more closely and identify its various components. Equity would be increased by the capital contributed by the owner. These are resources such as cash that are invested by the owner into the business. In a company, this will be called share capital. The owner may also withdraw resources such as cash from the business for personal use. This is called drawings and will reduce the equity of the business. In a company, these drawings are called dividends. A business will generate revenues through the sale of its products and the provision of its services. Revenues will result in an inflow of resources into the business. As a result, revenue will increase equity. Now, in order to generate this revenue, a business will have to consume resources. The consumption of resources of a business is called expenses. As expenses result in a decrease in the resource, it will reduce equity. Now, if we are able to generate revenue that exceeds expenses incurred, a business is said to make profits. If, however, revenue generated is less than the expenses incurred, a business therefore makes a loss. Now, with the understanding of the components of equity, we can now revisit the accounting equation. The accounting equation can now be extended to include the components of equity. Let's now look at a merchandise store startup example. We will use this worksheet to analyze the first few transactions of the startup business against the elements of the accounting equation. Let's begin with the owner investing $150,000 in cash in the business. What is the effect on the assets of the business? Well, there will be an increase in cash by $150,000. Now, at the same time, this represents capital contributed by the owner. So we will increase the capital by $150,000 as well. So you can see that the business so far has cash resource or assets of $150,000, and this is claimed by the owner as capital and shown under equity. So subsequently, let's say the owner took out $100,000 in cash and used it to purchase a shop in order to run the business. Now, the effect of this transaction is to reduce cash by $100,000, and there will be an increase in shop by the same amount. As you can see, after this transaction, there is no change in the amount of claim of the owner on the assets. What has changed is the conversion of some of the cash into shop. The total assets remains at $150,000. Now let's say in order to fill up this shop, the owner decides to buy merchandise worth $20,000. The owner buys the merchandise on credit so that he can pay later when he has made some sales. Now, the effect of this transaction is that there will be an increase in stock by $20,000 when the merchandise is received. There is no impact on cash as the owner has not paid for the merchandise. So there will be an amount owing to the merchandise supplier, which represents a claim on the resource of the business. This will result in an increase in liability under creditor. As you can see, the total amount of resource have increased from 150,000 earlier to 170,000 with the addition of the stock. The owner's claim remains at $150,000, but now there is an additional external claim of $20,000. Now that they have merchandise in the shop, the owners can now open for business. After a certain period of time, the owners manage to sell half of their stock of merchandise for a total of $18,000. Now, there will be two separate transactions for this sale, and we will account for them separately. First is the reduction in merchandise as they are given out to the customers. This will result in a decrease in stock by $10,000, which is half of the $20,000 stock just before the sale. This reduction in stock represents the consumption of resources to meet the needs of the customer. This will result in a reduction in equity and classified as an expense, which we will call cost of goods sold. Now, the second part of this sale transaction is the revenue that is generated. This represents how much the business charged the customers for the merchandise. In this case, $18,000. There would be an increase in cash if the merchandise was sold for cash. However, the owner sold the merchandise to the customer on credit, probably delaying collection to encourage sales. Consequently, there will be an increase in debtors by $18,000, which represents the business right to collect from the customers. As this represents revenue generated, there would be an increase in equity of $18,000, which we will classify under sales. These sales were not made just by the effort of the owner alone. The owner hired a shop staff to help with the sales. For the work and effort of the sales staff, a salary of $5,000 was paid during that period. The payment of this salary will result in a decrease in cash by $5,000. The salary paid represents resources used to generate revenue. Consequently, there will be a decrease in equity, and we can classify it under salary, which is an expense to the business. Finally, let's assume the owner had to take out some cash from the business for his own personal use, maybe to buy the spouse a present for their anniversary celebration. The $1,000 cash taken out will result in a reduction in cash, of course. This results in a decrease in total resources and at the same time a reduction in the owner's claim in the business. This is recorded by a decrease in equity we can classify under drawings. Now that we have completed analyzing and recording the transactions, we can find out the balance of the various elements of the accounting equation. The balance of cash will be $44,000. The shop will have a balance of $100,000. The remaining stock will be $10,000, and we will have debtors amounting to $18,000. There will be a claim from a creditor of $20,000, and the amount contributed by the owner in the form of capital remains at $150,000. There has been a total of $1,000 being drawn out of the business, and the business have generated a total sales of $18,000. And in order to generate that sale, the business have incurred a total of $10,000 in the form of cost of goods sold and have incurred salary expense of $5,000. Now, in order to ensure that we have followed the accounting equation framework, we will need to sum up all the resources or assets of the business, which amounts to $172,000. This must equal to the sum total of all the relevant claims of the business comprising its liabilities and equity of $172,000 as well. Now, a few additional comments on the worksheet before we move on. Now, each of the columns that represents a description of the different elements of the accounting equation is what we call an account. Now, in order to conform with the accounting equation, you will have note that for every transaction, there will always be at least two equal effects on the elements of the accounting equation. This rule is called the duality principle or the double entry system. Let's now look at the preparation of the two primary reports called financial statements. First, we start with a report on the financial performance of the business, which focuses on the revenues and expenses and the resulting profits or losses that is generated over a period of time, normally for a year. This report is called the income statement or the profit and loss statement. The income statement starts off by reporting the total amount of revenue for the period, in this case, sales revenue of $18,000. It then lists down the relevant expenses incurred to generate this revenue. In this case, it's the cost of goods sold amounting to $10,000 and the salary expense of $5,000. Since the total revenue exceeds the total expenses, there is a net profit generated by the business during this period of $3,000. Now let's examine the other financial statement called the Statement of Financial Position. The Statement of Financial Position reports the elements of the accounting equation, showing the nature and amount of resources controlled by the business and the respective claims on these resources as at a particular point in time. Following the accounting equation, we will start off with listing all the assets of the business. First, we have cash amounting to $44,000. This is followed by shop amounting to $100,000. Then we have stock of $10,000. And finally, debtors of $18,000. This will give us a total asset of $172,000. Then we list down the liabilities of the business, in this case comprising only the creditors of $20,000. Finally, we list down the components of equity, starting with capital contribution of $150,000, followed by a drawing of $1,000, which we will deduct from the equity. As for revenues and expenses, we will only report the net profit of $3,000 taken from the income statement. This will give us a total liabilities and equity of $172,000. Since the statement of financial position represents the accounting equation, the total assets must equate the total liabilities and equity. Thus, both sides of the statement of financial position must balance. Hence, this report used to be called the balance sheet. To summarize, let's put the two types of financial statements in perspective. The statement of financial position is a snapshot at specific points in time of the resources held by the business and the claims on these resources as represented by the accounting equation. The income statement reports the financial performance of a business for a specific period of time, which is represented by revenues less expenses and whether a net profit is generated or a net loss is incurred. In this video, we have explored how the accounting equation is used in analyzing and recording business transactions, and how the primary financial statements are constructed. In future videos, we are going to build on this framework and explore the basic underlying principles that are used in recording business transactions and preparing financial statements. I would love to hear your comments, feedback, and views on this video. Please do like and share this video with your friends and course mates. I hope you will subscribe to my channel for more future videos. Till we meet again, please do stay safe and take care.